Hello, I'm Thomas Cloud, the president of Third Act Retirement Planning. I wanted to talk to you briefly today about the market and what's happening. We've seen a 25% drop from the peak, which was 3,393 on the S&P 500, and we're down about 25% from there. What we want to talk about first of all is the 10-year Treasury yield, which is at a 54-year low. In February 26th of 1962, the 10-year Treasury yield was 4%. Today it's about 0.87%, so a little less than 1%. The 30-year Treasury yield is at a 39-year low. Back on February 28th of 1977, it was about 7.82%. And today the 30-year Treasury yield is 1.28%. So this lets us know we're kind of running out of places to hide, and it kind of reminds me of the Japanese situation back in the mid to late 80s, if any of you remember that. So we're in a situation where putting your money into even the longer term Treasury bonds is not going to yield you much of a return. In the meantime, we've had the U.S. stock market go up from March 6th of 2009, when it was the S&P 500 was 666, all the way up to 3,393 on February 19th. So that's an 11-year time period with a compound annual rate of return of 15.94% per year. Whereas the long-term average of the U.S. stock market has been around 9% a year, 9.5% a year. So here we are averaging more than 50% more per year over this 11-year period from March of 2009 to February 2020. So we're down 25%, and that's good. That's a start. However, I think for us to consider what would be a real correction that would have meaningful growth opportunities moving forward, I think we want to see about a 40% drop down to about 2,000 on the S&P 500. As of today, we're around 2,500. A 30% drop would be going down to 2,375. The other thing that I want to talk about is the historical price-to-earnings ratio on the S&P 500. As companies grow their earnings, their price goes up. And people are willing to pay more for companies sometimes based on what they're earning than others. Historically, the S&P 500 price-to-earnings ratio has been about 15. People are willing to pay about 15 times what the company's earning for its stock. Now, as we were in February 1st of 2020, the price-to-earnings ratio had gone all the way up to 25. That is 66% higher than the historical norm of 15. Right now, the price-to-earnings ratio is estimated to be around 19. So, as we can see, we still have a ways to go back down to the historical average. Typically, when we have bear market corrections, we don't just go down to 15 and stop. We'll typically go all the way down maybe to 10, maybe even to 5. And that would be a substantial correction where you would see the S&P 500 maybe cut in half and go all the way down to, say, around 1,500, somewhere around there. So, just wanted to let you know we've had an amazing 11-year run at a 15.94% compound annual rate of return, which is outstanding, almost 16% a year. It's time to give the devil his due. It's time to pay the piper. You shouldn't be investing in the stock market if you can't live with these type of turbulent situations. It's being driven, of course, by the worldwide scare around the coronavirus, which concerns me because it makes me wonder, is this an emergency-driven correction, or is this a true correction like we saw during the financial crisis or Great Recession of 2008? And I'm hoping this is going to be a true correction. We're already down 25%. Let's see if we can knock out another 15% and call this thing a day and continue on with our decade. Most experts agree, and I've talked to my clients about this, that the average rate of return for the U.S. stock market from January 1st, 2020 to December 31st of 2029 is going to be about 3% a year. And what that means is that we will most likely have a year or a time period usually probably no more than 18 months where the stock market takes a tremendous drop. And maybe this is it. So let's keep rooting for us to get down to 2000 and hit the reset button, and then we can move on with this decade with a little more stable returns. But of course, there's no way to tell. Economic uncertainty is certain.